Kia ora, and welcome to tonight's live podcast of the New Zealand First Homebuyers Guide and Insight. We are thrilled. Oh, I'm actually by myself here, not with Marianne tonight, unfortunately, because she's quite busy with her mate. But anyway, I'm thrilled to have you with us, joining us this evening as we dive into an incredibly important topic, so relevant to first home buyers, especially Home Grants 2024 updates on the DTI. What is this? And the LVR regulations. So, if you're new to this technical terms, this is the right avenue for you to learn more about it, especially if you are eyeing to buy your first home soon. So there are many changes every now and then, and it's best to be updated, right? So we don't miss out on opportunities. In this episode, we'll cover the latest changes to home grant eligibility, explore the impact of the new debt to income. That's the definition of DTI ratio. DTI, that's DTI ratios, and discuss the adjustments to loan to value ratio requirements. We'll also delve into the specific benefits and incentives available in the updated home grant programs and provide tips on how you can best prepare financially to meet these new regulations. And of course, all these updates will be coming from an expert, not from me, our esteemed guest, a seasoned mortgage advisor with a wealth of knowledge and expertise, always up to date in helping us, especially the first home buyers, navigate the complexities of home buying process. And he's joining me and this live podcast once again for the third time. So I'm really pleased to welcome Sanjeev from Loan Market. Thank you so much. Appreciate your time.
Thanks, Julie. Thank you.
Right. So, yeah, I've contacted you again because of this recent updates on the home grants. Would you like to tell us more about this one, please? Because I feel a bit sad on this.
Yeah, of course, a little bit of a bad news for the first-time buyers just to start with. Obviously, the national government wanted to cut the cost, and first thing we were looking at was Kaingaora. So going forward at this stage, they will not be offering any first home grant to first home buyers. So previously, if you were contributing to KiwiSaver for say 3 year or more, you could get up to $5,000 first home grant if you were buying an existing home, or up to $10,000 if you were buying a new build property. So for a couple, first home buyers, you could get up to $20,000. So there was a really good help for the first home buyers. But obviously, at the moment they've chopped that program, so you won't be getting that grant anymore. But I'm pretty sure they will come up with something else in the future.
Also, is this already taking place or not yet?
It has already. I think they stopped a couple of weeks ago, so not taking the new applications anymore.
It's really a shame. So, have they created a new program for the,
Not
for
yet, not
no?
yet. But I hope they will come up with something very shortly.
Oh, that's really sad. But yeah, I'm hoping
Yeah,
that they
because their
new.
take was, hey, look, you can't just getting extra $5,000 or $10,000 shouldn't change your trajectory to get a first home loan. They'd be like, hey, look, it's just $5,000 or $10,000, right? You will still have other ways to bring your deposit up, like your personal savings or gift from family or other bits and pieces. So at the moment, nothing.
Oh, so have they given any idea as to when are they coming up with a new program to help the first home buyers or?
Not yet. Look, I mean, for them, they're still doing these Kainga or first home loans and other bits and pieces. It's just the grant, so they're not giving away any free money anymore. But you still, I mean, the first home buyers can still take the advantage of the Kainga or first home loan. So usually you need a 20% deposit to buy a house, but under this program, you can buy a house with as low as 5% deposit. So that's the only thing they're doing at this stage. I mean, there are other programs like shared ownership, like where there are some organizations where you can still buy a house like under a shared ownership scheme, but it's not available to everyone.
Yeah, because I know a lot of people, a friend of mine, are actually like waiting for their Kiwi savers to mature because they've been saving up for a couple of years, and it needs 3 years before it matures so that they can also avail the home grants. Unfortunately, like what I've been telling them, grab whatever opportunity you have right in front of you because anything can change anytime. Like this now, it's quite
Yeah,
sad because 10,000 for each one of you. If you're a couple, then that's 20 for
that's a
a
lot
new
of money.
couple.
Yeah.
That's still a big amount. That's a shame. So
Yeah,
guys,
but then again, for that, like only people who were earning less than $150,000 combined would be eligible for it. Like, if your income was more than $150,000 in the last 12 months, then you don't qualify for that anyway. And then you have to be contributing to KiwiSaver as well. Like, not everyone has KiwiSaver.
oh yeah, yeah. Oh, so just to clarify, you're saying that those who can avail the home grant are having a cap on their income. Is that what you mean?
Correct. So there used to be a cap
Mm.
for the scheme. So if you were a single person, your income in the past 12 months was supposed to be less than $95,000. If you earn $1 extra, then you don't qualify for it, right? If you were a single parent or a couple, then
Yeah,
you were capped at $150,000 combined income. So anything more than that, then you don't qualify for the grant. So
you don't. You still
yeah,
didn't.
no, exactly. So not everyone was qualifying for it anyway.
Oh,
So
okay.
yes, there are a lot of people affected, but it's not end of the world. There are other ways to make it work.
Yeah, yeah, yeah. Okay, but now, even if your income cap is still I mean, income still within the cap, there's no more home grant. In other words,
Yeah, exactly. So no free money, but you are still eligible for the Kayang or a first home loan product.
right? Since you mentioned the Kainga Ora, what is this? What are the qualification, and how can they apply? Maybe you can delve deeper into that.
Oh, absolutely. So usually you need 20% deposit, as I said. But if you have less than 20%, let's say, for example, you have 10% deposit and you go to your bank and then get the loan, number one thing, they will be testing you at a very high interest rate. And the second thing was they will be charging you about, say, 0.75% extra on top of whatever the advertised rates are. For give you an example, let's say ASB's 1 year rate is say 7.24%, and they'll add another 0.75% margin on it, and then you'll be paying say 7.99% for 1 year until you have 20% equity in the house. So either your property value goes up or your loan goes down below 80%, then they will remove the extra margin. But until then, they will keep charging you that extra money. But
Right.
under the Kayangaora policy, you
Oops. Oh dear. I don't know what happened, but
but
oh,
then you'll be paying. Can you hear me?
sorry, I lost you with that one. I don't know what happened.
Okay. So under Kayangaora policy, so you can buy your first home with as low as 5% deposit. The banks will not charge you any penalty or a low equity margin. So you'll be paying the same rate as someone with a 20% deposit. The
Mm.
only difference is you'll be paying 0.5% of whatever you're borrowing as a one-off fees to Kayangaora. They call it lender's mortgage insurance. So let's say you borrowed $600,000, so you'll be paying $3,000 as a one-off fees. But the benefit is, regardless of the property goes up or down, you won't be paying anything more than whatever the advertised rates are. So you don't pay any extra interest. So you're saving in a longer run. So you still qualify. I mean, that program is still there, and that's not going anywhere at the moment. So we're still doing a lot of applications under that program. The only
Oh,
difference is you don't get the grant. Yeah.
oh, okay. So that's good. But that's under the Kainga Ora if you qualify.
Correct. Yeah, but even
Mm,
if you don't qualify, my message to the first time buyers is okay, let's say you don't qualify for the Kayanga or a loan, but you still have 10% deposit and your income is good enough, then yeah, just buy the house with 10% deposit because majority of the first time buyers will have only 10% deposit, right? There's
yeah.
hardly anyone with the 20% or someone with the rich parents or who have like a lot of equity in the property, etc. But majority of first time buyers will only buy the house with 5 or 10%, 15% sort of a deposit.
Yeah. So with 10%, any banks will lend you that money, right?
pretty much.
But the 5% is only with Kainga Ora because you'll be sharing with them.
Yeah, so no, you're not sharing the house with them. So
Oh.
the Kayangora first home loan, it's done by only a few lenders. Like the main lenders are Westpac, Kiwi Bank, SBS,
Oh.
those sort of lenders. So they will do the loan. So the bank gives you the money, Kayangora just becomes your guarantor. So that's why they charge you that 0.5% fee, right? Because
Yeah.
usually why the bank charge you higher fee or the low equity margin? Because they're taking the risk on you, right? So that's why they charge you higher interest rate. But under the Kayangora policy, Kayangora says, hey, look, if these guys default, we have insurance in place and then we will look after. So that's why they charge you the insurance fees upfront. So then the bank will treat you in the same way that they will treat someone with the 20% deposit. So the lending criteria is a little bit lenient. You get a little bit more lending, and your interest rates are cheaper.
Yeah, that's quite good if you qualify under the Kainga Ora. But then, so to those who miss out the previous information that Sanjeev has given, for a single applicant, you need to have below
Uh,
90K
Yeah, so
income.
your income in the past 12 months. So they
12
will
months.
they will ask you to provide IRD earning summary report for the last 12 months. So if your income was less than $95,000, then you qualify for it. Or if you are a single parent, so you don't have a partner but you have a child, or you are a couple, and if your combined income in the past 12 months is was less than $150,000, then you will qualify. Now, one thing to be careful about this one is a lot of time people look at their current income and they think, oh, now because our income is $160,000, we don't qualify. That's
Yeah,
not the case. They look at the past 12 months, right? So today, let's say you got a pay rise last month, and all of
yeah.
a sudden your income today is $200,000, right? But in the past 12 months, you've only earned less than 150. You qualify for this. Okay. So
Mm,
when the bank gives you the loan, they will use your current income, which is like $200,000, to give you the loan. But to meet Kayangaura's policy, it needs to be less than 150 in the past 12 months. So it's a win-win for like first home
yeah.
buyer.
So that makes it clear. But what if you have just started working for like 6 months? Will you
Yeah, so
still?
you need to be in the same employment for 1 year, or you should be working in the same field for at least 2 years if you have just recently changed your job.
So if you don't,
If you don't meet that criteria, then you have to wait until you complete 1 year in that employment because they want to see some stability. Because yeah, we've seen some people like today they're working as an admin, tomorrow they're working as a mechanic, and then they go back to admin. So jumping ships. So that's when they, because the banks are taking a huge risk giving you up to 95%. So remember, it's not you buying the house, it's the bank buying the house for you, right? And then tomorrow you don't want to work, then the bank gets in trouble.
yeah, fair enough. So they just want an insurance that, you have the ability or the discipline to be able to pay.
Absolutely.
But of course, for specific case, if you want to ask more about you qualifying to qualify under the Kainga Ora, feel free to contact Sanjeev anyway for the best advice for your case. Let's move on to the DTI. What is this really? Because a lot of our viewers are asking, what is this and how does it impact their buying ability?
Yeah, so DTI or debt to income ratio. So that's another tool that Reserve Bank had in their back pocket, and now they're bringing it into action from 1st of July onwards. So basically, what it means is if you're buying your owner occupied property, you can only borrow up to 6 times of your gross income. And if you are an investor, then you can only borrow up to 7 times of your overall gross income. So, for example, if you are a couple and then you have a combined income of say $120,000, with the $120,000, you can only go with 6 times of that, right? So that's about $700,000 mortgage,
Mm,
right?
okay.
So you can't borrow anything more than 700. So let's say, for example, you have a car loan. right? So your income is $120,000 and you got a $20,000 for car loan.
So deduct.
So 700,000 minus 20,000, 680,000 is the max you can afford.
Okay, so it's like all of your debts and
All of your
consolidated.
debts.
So deduct that one from your ability to loan. How much? Yeah. Ah, right.
Absolutely.
Because the OCR is still the same at the moment, but then they've increased the DTI, right?
Yes, so what they are looking at is because we go back 2 years ago, so some people are borrowing up to 8 or 9 times of the income. They are the one in trouble, right? Because the interest rates were so cheap, you were paying
Mm,
only 2.1, 2.19 sort of interest rate, and all of a sudden those guys came up for renewal at 7%. Couldn't afford that mortgage. That's why people are in trouble. So the Reserve Bank doesn't want that to be repeated, and also the property prices shot up so fast. So they want that to slow down, or it needs to be like a bit consistent, not like all of a sudden like the market going up by like 30%, 40% sort of thing. Yeah,
that
so that's
yeah,
what they're bringing in DTIs.
yeah. Because should we say that that was also the government's fault for letting them borrow that much before, or
Ah,
it was?
absolutely. Yeah, you can blame anyone.
Yeah, but well, we didn't expect that to happen anyway. They were just encouraging more people to, take their money out and buy so that the economy will keep going. I think that was their main purpose why it happened.
Absolutely, but then going forward, they want this to be like a bit stable. So they wouldn't mind if the market is going up by say 5-6% a year. They just don't want another 25% in 1 year, sort of a shock wave.
Oh, yes, yes. Have you had any client coming back to you after they bought their house in 2021 at the peak of the market and then they were like in trouble and asking for your help on how they can sort out their finances? You had any, and how did you help them?
Yeah, so then again, it's case by case sort of a scenario. Majority of our clients were with the banks, and so the good thing about the banks is like they're really responsible when they lend, especially in New Zealand. So I remember these conversations in back in 2021, right? So I'm talking to people. Um, they will come to me, hey, what's the testing rate, right? So when the bank gives you a loan, they test you at a very high rate, right? So although back in the days the interest rate were like around 2%, but they were checking people and then seeing if they can afford the same mortgage at 5.8%, right?
Mm,
So they were testing at 5.8%. But then people were yelling, saying, "Hey, look, why the banks are so strict? Right? They should be testing us at like 2% or 3%,
yeah.
right? That's a lot of margin." But 2 years down the line, then they understood, okay, yeah, if they wouldn't test them at 5.8, like you can imagine how much trouble these people would be in.
That's
Yeah, so the banks do have a lot of plans in place. So one of them is you can request interest-only payments from the bank. So that will bring your repayments down a little bit. So they can give you like a 6 months to 1 year, 2 years sort of interest-only payments as long as you meet the criteria and stuff. That's one option. Second is obviously I mean, that's absolute worst case scenario when there's no way you can't even afford the repayments. I mean, the interest. Then you can apply for a hardship. So the bank will then work with you and then see, hey, look, you can't afford $1,000 a week, but can you afford 500 a week? At least you're paying something back, right? So that's their mortgage holidays are there, and it depends on your,
case.
the overall picture, exit strategy, sort of thing. So they will work out. I mean, I don't think many people in trouble just yet. I mean, none of our clients. Yeah, I had a couple of clients with the non-bank lenders. So they borrowed till their neck, right? So because those
Yeah,
lenders were lending them up to 80%. They
that's
bought at the peak of the market where, for example, they bought a property for $1 million. Interest rate at the time was 3% for them. All of a sudden, the fixed rate expired. Now they're paying 10% interest rate, and that same property, the $1 million property, is only worth 800. So
yeah.
they stuck on every angle. So now we're working with the lenders and then putting them on a, like interest only or some sort of payment plan just to go through this period.
Yep. Yep, it's quite a hardship for those people who bought at the peak of the market and now they're probably struggling, but they can still probably live by it. Anyway, you've mentioned, oh, we lost him again, but he mentioned about, oh, his back. Okay. I keep on losing. Anyway, right. You've mentioned about the negotiation with the bank. So it's good if they are lending money from no, not lending money, but borrowing money from the bank. Hey, the interest rate is low, and then they can negotiate with the bank. So that's really a good way to work out the repayments. Now, well, this is really good to get an update from you, especially that you're a mortgage broker, because at the end of the day, they will have to first reach out to a mortgage broker before they start planning to buy a house, right?
Oh, absolutely. I mean, that's the best way to do it. I mean, you can walk into any branch, you can go to a bank, but then you go to one bank,
Yeah,
you only talk into one bank, right? So you don't know what the other bank can do for you or how you can pay off this mortgage in 10 years instead of 30 years, that sort of thing. Yes, just coming back to the DTIs, there's a lot of noise in the air about DTIs, but then there's nothing to be scared about just yet. So DTI will only be impactful when the interest rates drop, right? At the moment, there's nothing to be scared about. I think DTIs will work in favor of investors
of the
for the
investment.
first year and a half or so, because at the moment we are sitting at a very high interest rate. So going forward, when the interest rates come down to around 5%, then your borrowing capacity increase quite a bit. That's when these caps will really be impactful. So I was doing a scenario for an investor just recently. So if I look at as is, right? So at the moment the banks are testing you at about 9%, right?
Yeah,
But when we look at say DTI rules, today this guy with a big portfolio he can barely afford extra 200 or $250,000, right? But then if the interest rate drop and then we go according to the DTIs, he can afford extra $1.5 million on top. So that's how impactful it's going to be.
yeah,
It's just like the Reserve Bank is thinking about like a year down the line, right?
yeah.
Because when the rates come down, they don't want the property to shoot up, and that's when people will be limited. And one other thing with the DTI is, it's like if you look at loan to value ratio restrictions, right?
That's another one
Reserve
I'm.
Bank is saying, yeah, so you need a minimum 20% deposit to buy a house, but banks can still lend more than 80% to first home buyers. So the banks currently can lend up to 15% of their book to people who have less than 20% deposit. So same rule will apply with the DTIs as well. So yes, they have restricted the owner occupied at 6, but the banks can still lend up to 20% of the book to people who can go over 6 times of the income, right? So I don't see it's like it's just it's the end of the world. So
Yeah.
banks will still be lending to people with over 6 times, 7 times if they want to.
So in other words, it's still a case to case basis depending on the lender, right? They're gonna assess your
Yeah.
finances, really
Yeah, so
decide.
if you give an example in today's day, so let's say you go to I don't know whichever bank, not talking about the Kayangora loan, so just like a
Yeah,
normal loan, right? So if you have a 20% deposit, if you have say 150 $200 left on like in surplus every month, right? So when I put the numbers on the calculator, if you have 150 $200 left after all your expenses, they'll give you the loan, okay? But when you have less than 20% deposit, at the same time, the same lender wants you to have at least $900 left over. Okay, so that's when they want you to earn more money. So they want a little bit more buffer. So same thing may apply with the DTIs as well. So if you're only borrowing up to 6 times of income, they'll be like, okay, yeah, if you have $150 left, then we'll do it. But if you want more than that, we want to see $500 left or $700 left over,
yeah,
right? After
yeah,
all your expenses.
yeah. Because I know some friends of mine and also some viewers who are interested of buying their first home, but they want this much because they have a lot of requirements for their first home. What's your say on that?
Look, I mean, it's not, it is hard, but it's not impossible. Just talk to a mortgage broker and see, work out your numbers and stuff. Yeah, if you're buying a new build property, for example, the criteria is a little bit lenient. compared to an existing home. So same rule will apply under the DTIs as well. So if you're buying a new build, that will be exempt. You can borrow more than 6 times of your income. And under the existing homes, again, it's case by case. Yeah, I think properties are the cheapest at the moment. I don't think the market going down any further.
Any, yeah.
Even if anything is going to be bare minimal. If first-time buyers can get onto the property later, they should within the next 3 to 6 months time, because I think by end of this year the investors will be back.
Nice. I was supposed to ask you like your last advice to our viewers who are thinking of buying their first home, and you've already said that one. So yeah, it's still the best time to buy. It's not going to go down any further. Uh, do you think
Right.
it's going to go up this year, or it's still going to stay
Right.
stable?
Yes, if I look at the predictions from say CoreLogic, right? So CoreLogic does a lot of
Yeah.
data analysis for the banks and economists and stuff. So they are saying we might see about 5 to 6% increase in the property prices by in this year, by the end of the year, and then next year they're expecting 7 to 8% increase, and then the following year could be up to 10% increase. So,
Wow.
if I give you an example, so you buy a house today for, say, I don't know, $800,000, right? If it goes up by 5%, it will go up by $40,000. So next year, the same house is costing you $840,000, right? And then if it goes up by another 8% on top, then you'll be looking at another $75,000 on top.
That's 100. Yeah, the
Yeah.
800 from 900, more or less.
Exactly. So if you look at the scenario here, say, let's say today the interest rates are high, but you're also buying the property way cheaper
Mm,
compared to what it's going to be in a year or 2 years time. So if you can buy something for 800 today and then it's costing you $900,000 in a year's time or 2 years time, although the interest rates have come down by 1%, it's still costing you more than what it's costing you today because you're borrowing way too much.
yeah. Oh, thank you so much for all of this clarification and the updates as well. I'm pretty sure our viewers and our friends are getting more clarification. And I advise you guys to just reach out to Sanjeev. I'm going to give you his details afterwards, after this live podcast. Again, Sanjeev, thank you so much for your time and for your
Okay.
expertise. Have a good
Thank you very
night.
much. Cheers. You too. Bye bye.
Right, guys, so that's it. That's pretty much it. It's just a quick one because we don't have Mary Ann with me anyway. When the two of us are together, we have a long show because we just love chatting and talking with each other. Mary Ann, enjoy your night with your mates. And I look forward to having you again. And next week, thank you again, Sanjeev. And I hope you guys will be able to get a lot of ideas. Like what I've said, policies change. The home grants is now over. You're not able to avail it anymore. But looking forward to another initiative by the government, another program that can help the first home buyers. Until next time, everyone, have a good night. See ya.